Hello everyone and welcome. My name is Elliot Gu. I'm co-founder and chief analyst for Deep Dive Investing, and welcome of course to the Deep Dive Investing YouTube channel. And I'd like to wish everyone out there a very happy 4th of July holiday. And today I'm going to talk about something, probably one of the most important economic reports that comes out about the health of the U.S. economy every single month, and that is actually the monthly employment report released by the Bureau of Labor Statistics. Now, I'm sure you've all heard of this. I'm sure you see all the media coverage on financial television, but also on the mainstream media every month about this report. It's probably one of the most widely watched economic reports of all. There are even stories of economists and traders being fired for not being at their desks at 8:30 a.m. when this report is released, usually on the first Friday of every month. And of course, in that report, we get a number of different statistics. We of course get the unemployment rate, the percentage of the labor force, these would be people who are looking for a job, actively looking for a job, but they're not employed. The unemployment rate as a percentage of the labor force. We also get, of course, the number of people, the number of new jobs created, the number of new payrolls created, both overall, private, and broken down by industry group. And although this report is extremely widely watched, a lot of the headline numbers that you see really aren't, in my experience, all that useful. So I know that's going to sound a little bit like heresy for some who've been watching this report for many years, but bear with me. Because what I want to do today is look at those headline numbers, where they are useful, the flaws there, and then I want to delve a little bit deeper into the report itself. One of the things I've noticed or found over the years studying economic data is that these government reports that come out, the numbers that the mainstream media focuses on aren't always the most useful, or certainly aren't the only useful aspects of that report. If you dig a little deeper, there's all kinds of other data series that aren't as widely watched. They can actually give you a lot more granularity on the health of the economy and just a lot better idea of what's going on. So we're going to look at some of those sort of sub-indicators that aren't as widely followed that I look at every single month. They can help you get more information and garner more color on the health of the U.S. economy. So in this short video, we're going to look at three key things, in fact, that I look at beyond those headline numbers. So let's go ahead and get started. I want to keep this video under control in terms of length. First up, let's look at probably the most widely referenced statistic, which is the U.S. unemployment rate. Obviously, you don't want to see a high unemployment rate, which you typically see during recessions, because it means a lot of people can't find work. And the U.S. economy, like many developed economies, is driven by the consumer and by consumer spending. And obviously, if people don't have jobs, they're not going to spend as much. The housing market's obviously related as well to wage growth and the health of the labor economy. So it's a widely watched number. But in terms of timing the cycle, it's of limited utility. And what I'm going to look at here is the official U3 unemployment rate over the last three tops of the last three economic cycles and the bottom of the last three economic cycles. So you can get a look at how it behaves. So first up we have and I'm going to throw the chart up here on the screen for you, the U.S. recession from December 2007 all the way up into June 2009. And what I've shown you here, the recession officially started in December of 2007, which is the far right edge of this chart. That blue arrow that you see there is actually the top of the stock market. So you can see from 2003 all the way up through 2006 and into 2007, the U.S. unemployment rate steadily declined. Now, of course, there were months, 1 and 2 month periods, even 3 month periods, where it ticked higher by, 0.1%, 0.5% even, or almost 0.5% at times over this period. But over that period, generally, it was trending lower, which is typically what you'd expect in an expansion phase. But at the time the stock market topped out in October of 2007, the unemployment rate was barely off its lows for the cycle. Subsequent to this, it went obviously a lot higher. We got up to over 10% during this economic downturn. But even at the beginning of the recession, and certainly when the market topped out where that blue arrow is pointing, the unemployment rate was only slightly up off its lows. So if you're looking at the unemployment rate as a way of predicting a coming turn in the economy, it's not that great. The stock market typically peaks long before the U.S. economy enters recession. Actually, in this cycle, it was only a couple of months. Normally, it's a lot longer than that. And the unemployment rate can actually continue to fall or only rise slightly even after the U.S. economy or the U.S. stock market's peaked. So if you're looking at it as a market indicator, it's really more of a lagging indicator, the unemployment rate, than a leading indicator. Not that useful. So let's look at a couple of other cycles here. I want to throw up on your screen the U.S. recession from March to December 2001. This was not a very severe cycle. It was much less severe than the 2007 to 2009 cycle. But let's put up a chart here of the unemployment rate over this period. As you can see, from the mid-1990s all the way up through into 2000, really through the end of 2000, the unemployment rate declined steadily. It kind of traded around that 4% level in 2000. But you can see at the time the stock market topped out, which again is marked by that blue arrow, the unemployment rate actually continued to fall a little bit for a couple of months after that and kind of stayed around that same basic range, didn't rise a whole lot, even for 9+ months after the U.S. stock market had already peaked. The U.S. economy entered recession officially in March 2001. By then, the unemployment rate had started to tick sort of meaningfully higher, but again, not a great leading indicator, at least for the stock market, in terms of a peak. So let's look a little bit, let's look at another cycle here. This cycle is another kind of mild recession, July 1990 to March 1991. The stock market actually only fell for a few months over this time period, from July until November of 1990. I show you the stock market peak here in July of 1990, and you can see that the unemployment rate, which had fallen from the late 80s all the way up into 1990 range, really didn't start to meaningfully rise until well after the U.S. economy had entered recession and the stock market had already peaked out. You'll also note that the unemployment rate's actually an even worse indicator of a market bottom. Typically, the unemployment rate will often continue to rise long after the stock market's bottomed out and long after the U.S. economy's exited recession. For example, in the most recent cycle, which was again from December of 2007 to June of 2009, the unemployment rate didn't peak out for many months after, and it was well over 10% after the recession had ended. So again, if you're looking at it as a way of timing either market tops or market lows, the unemployment rate, again, it's kind of a lagging indicator. One more cycle, and I won't go into too much detail here, but this was another severe one from the early 70s, early mid-70s. The recession was from November 1973 to March 1975. The only other recession that was longer than this in the post-war era, since actually the Great Depression, in fact, was that 2007 and 2009 Great Recession. But you can see here, the blue arrow again points out January of 1973 when the stock market topped out. The unemployment rate continued to fall steadily long after the stock market topped out and really didn't start rising until early 1974 significantly, long after the U.S. economy had already entered recession and long after the stock market was well off its January 1973 high. So again, not a particularly useful leading indicator. And you can also see, by the way, on that chart that the unemployment rate remained very elevated even after this recession had ended for quite some time. So not a good indicator of the low there either. Now, of course, an equally widely watched number to come out of the weekly employment report is non-farm payrolls. In this case, I'm going to throw up a chart for you of private payrolls. This excludes government workers. I actually prefer looking at private payrolls to government payrolls. Government payrolls, for example, sometimes they'll expand even in a recession because the government's kind of trying to stimulate the economy and buy us out of a recession. So I think it's cleaner just to look at private part of the U.S. economy, the more important part of the U.S. economy by size. And so I look at private payrolls. They're also more sensitive to the health of the economy, whereas government payrolls can be kind of counter-cyclical. But I took this chart all the way back to the mid-1990s. So I took this chart back a long time now. And what you can see here is these black bars, this histogram, if you will, is actually the monthly change in private payrolls. Now, you can see the two periods of negative payrolls there, which of course were the 2001 recession and the 2007 and 2009 recession. The 2001 recession being relatively mild, the Great Recession being pretty nasty in terms of job losses there. But also I want you to kind of look at that, step back and take a big picture look at this chart. And you'll see that there are a lot of months in here, and I'll kind of circle some here on the slide on your screen, where payrolls growth was negative or close to zero or very low, even though the economy was in the middle of an expansion and not headed for recession. So there's a lot of volatility in the month-to-month payrolls. And to make matters worse, this is actually the revised data. The government issues sort of a preliminary number every month, which is widely watched. For example, this last month, on July 5th this year, the government announced a much larger than expected 191,000 increase in private payrolls. It was over 224,000 total payrolls, 191,000 private payrolls. This was much larger than anyone had expected. But just last month, about a month ago in early June, when they announced the May payrolls number, they only announced an increase of 75,000 jobs versus I think 180, 190,000 expected. So well worse than what Wall Street consensus had expected. So there's a humongous difference in month to month in volatility. I've also seen issues where initially the initial number reported, the first number reported, was way off expectations, but 6 months later, when the government kind of had finished revising everything, the number was actually better than expected. That's happened many times. So looking at the month-to-month swings in payrolls data, it's really hard to draw any concrete conclusions from that. And I know that I've read over this weekend, this is again the weekend after July 6th, July 7th, just after the payrolls data was released on the 5th, the day after 4th of July. I've seen all this commentary, well, the Fed was going to cut interest rates on July 31st this month, but now that the payrolls data for June was so much better than expected, they're not going to cut. They're going to wait till September. And that may or may not be true. Right now, the Fed funds futures market is pricing in a 100% chance of a cut, at least a 25 basis point cut in interest rates on July 31st, which is the Fed's next meeting. Right before the report, they were actually pricing in about a 75% chance of a 25 basis point cut and about a 25% chance of a 50 basis point cut. So the market's still expecting a cut. They're just not seeing as much of a chance of an even bigger cut of 50 basis points. They're just looking for that quarter point. Whether this does not cause the Fed to change its plans in terms of cutting interest rates, it's hard to say. But in my view, it shouldn't. What's more important isn't those month-to-month wild swings, which will probably be revised away anyway. It is the longer-term trend in this data. So that actually brings me to my first sort of, it's not really a secret, but the way I like to look at this data, if you will, a sort of secret look at payrolls, and that's just to look at the moving averages instead of the raw data. You will drive yourself crazy looking at that raw data because the month-to-month swings are so wild and you get such big revisions. But if you look at, I like to look at the 3-month simple moving average, the 6-month simple moving average, and the 12-month simple moving average. And I've overlaid these on this chart. This is the same chart I showed you earlier, going back to 1995, but just those 3 moving averages overlaid there. And you can see I've got the 3-month in purple, I've got the 6-month in green, and I've got in yellow the 12 months. And what you can see is kind of at the end of an economic expansion, you'll see a lot of volatility in the month-to-month data. You'll see months where the jobs gains are way more than expected, months where they're way less than expected. But at the end of an economic cycle, you definitely begin to see those 3 moving averages start to trend lower. So the 3 moving averages kind of come out of a recession, they rise, they kind of trend along in a range for much of the expansion. And then at the end of the expansion, you do tend to see a deterioration in jobs in the jobs market. We certainly saw that back in 2006, late 2006, about a year before that expansion ended. We also saw that back in 2000, few months, say 9 months before the U.S. actually entered recession in March of 2001. So that's a little bit more useful, I think, than looking at the raw data. Let's just take a quick close-up look. This is just those three moving averages for the jobs data over just the past couple of years. And regardless of the commentary you might have seen a month ago about the jobs number being way worse than expected, and this month it being way better than expected, there's a definite trend here, right? You can see that those moving averages have started to kind of roll over a little bit. That tells me that the U.S. economy is definitely slowing. This isn't enough of a deterioration in the trend yet to say to me that the U.S. economy is poised to enter recession, but look at those moving averages more than the raw data, and you can definitely see that there is a deterioration in the trend. The fact that this month's data was better than expected, last month's data was worse than expected, doesn't really matter. What matters is that this overall trend over the last 3, 6, and 12 months is beginning to deteriorate. And you can definitely see it, I think, on this close-up chart of the data with those simple moving averages. Okay, so that's actually, you may have even seen that indicator used before. In other words, just instead of looking at the raw data, look at the moving averages. This one you may not have seen, okay? And this is actually, what I've done here is, this is called the Employment Diffusion Index. And so what that is the Bureau of Labor Statistics actually provides a lot more granularity on payrolls than just how many total private payrolls and how many total government payrolls are added or taken away in a given month. In other words, how many jobs are added. They also look at it broken down by different industry classifications. And so you might have retail, manufacturing related industries, etc., all kinds of industry groups that they classify. And what the diffusion indices look at is basically the percentage of those industry groups that are adding payrolls or adding jobs, the percentage that are losing jobs. And so this indicator trends between theoretically 0 and 100. At 100, a level of 100, all industry groups would be adding jobs. At a level of 0, they would all be losing jobs. So really the higher the diffusion index, you want to look at the absolute level of the diffusion index as well as the trend there. Now I took this back to the late 1990s and I looked at the diffusion index over the last 3 months and the diffusion index over the last 6 months. So this is the percentage of industry groups over the last 3 months that are adding to jobs payrolls and over the last 6 months that are adding to jobs payrolls. And this gives you an idea of the breadth of the labor market. In other words, how many industries are actually expanding? Is it just a few big industries that are adding jobs and therefore the overall numbers don't look pretty good, but there's sort of weakness underneath? This is what you can see with these employment diffusion indices. And what you can see here is that typically you will see a deterioration, a meaningful deterioration in those employment diffusion indices sometime before the U.S. economy actually enters recession. You can see it back here in late 2000, before the 2001 recession, and you can definitely see it in 2007, before the recession that started at the end of 2007. So this gives you a little bit earlier warning signal than the trend in the payrolls themselves. Looking at when fewer and fewer industries are adding to employment, that's a bad sign. And again, look at the far right-hand side of the chart here, and you can definitely see that there's, again, some month-to-month volatility, but the diffusion indices have been coming down this year. So fewer industry groups are adding to employment gains this year than, say, was the case last year or the year before that. Again, not yet at a level of deterioration which would signal an economic downturn. I would want to see those diffusion indices get down around 55% before I would get really concerned about a recession, but definitely a deterioration there. And this last month's data doesn't really change that pattern. Yes, it caused the 3-month diffusion index to tick a little bit higher, but the 6 months is still clearly in a downtrend. Clearly a soft patch in the U.S. economy underway right now, regardless of whether last month's payrolls were a little better than expected. So let's flip on to Another indicator that comes out of this report, and this one is actually kind of a good, quick and dirty method for forecasting U.S. economic growth. And what it is it's aggregate hours worked. So what that is we look at the total number, the average work week in the U.S. and the payrolls, and we sum that up. And so we look at the total number of hours worked by all employees across the economy. So obviously, if you have more people employed, working, say, longer hours, you're going to have a big expansion in aggregate hours. Now, what I've done here is the black line on this chart is the aggregate hours worked on a year-over-year basis. And then I've also looked at two different measures of GDP. One is the seasonally adjusted annualized quarterly rate. That's the more volatile series there. The other one is just the year-over-year growth in the economy. And you can see that that black line, which is aggregate hours worked, which is released as part of every month's employment report, has sort of tracked those GDP growth rates over time. Now, why is this useful? Can't you just look at GDP growth? Yes, but GDP growth is only released every quarter and with a lag. The employment data is released every month with a much smaller lag. So if you see the aggregate hours declining, it probably means that the next GDP growth rate is going to be lower, okay? And you can kind of see, you can see how well it tracks over the long haul. And what's kind of concerning in this picture right here, look at the far right-hand side. Do you see how that black line, the aggregate hours number, has trended down to about 1.5%? GDP growth in the last quarter was pretty strong, right? But this suggests to me that GDP growth is definitely slowing. Now, we've certainly heard predictions of that, but this number tells me that nothing's changed there. GDP growth is still weak, and it's weaker than GDP growth was in the last quarter, so GDP in Q2 and Q3 seems to be trending a bit lower here. If this trend were to continue, we would see aggregate weekly hours drop down to sort of under 1.5%. Annualized, or 1.2%. That would be the lowest level we've seen in aggregate hours since the early days of this expansion back in 2011. That would be a very bad sign. We're not yet there just yet. We're not there just yet, I should say. But we are back to the kind of expansion levels that we saw back in 2015, 2016, which is another big soft patch for the U.S. economy. So it is telling us that the U.S. economy is slowing down. When the U.S. economy slows down, when we see soft patches, that's when the odds of at least a deep correction in the stock market are higher. You tend to see more volatility in periods like that. We saw some of that back in 2015 and early 2016 when we saw a very large correction in the S&P 500. We of course saw a correction late last year. We saw a correction more recently in May and June. I think we could be in for some more corrections later on this year because we are still mired in that soft patch. So even though I don't think this bull market is over yet, I think we will see fresh all-time highs. I would be prepared for a little bit of volatility there. So I hope that helps kind of give you a little bit more color on the monthly employment report. All this data is publicly available in the report, but you probably won't hear about it on financial news. I hope you found this video useful. If you did, please drop me a like at the bottom of the screen. Also, feel free to subscribe, totally free, to our YouTube channel to be alerted when we have new videos coming out. In addition, I have one more thing to announce in this video, and that is that later on this month, and it's July of 2019, I am planning to host a free webinar. It's open to anyone. It's aimed at those of you who are subscribers to this channel, where I'm going to talk about the outlook for the U.S. economy and the stock market in the second half, some of the industry trends I see. It's totally free of charge. If you're interested in it, you're welcome to sign up. I'm going to leave the link in the description section below this video, and you can go there, put your email address in. I've tentatively set the date for later on this month. Honestly, that may change depending upon how many people we get to come onto this. We may hold it a little bit sooner, and exactly what we're going to cover. But I am planning to do it later on this month in July 2019. If you're interested, drop your email address in there, register for the webinar, and we'll alert you when it's there and also send you a copy of the recorded version of the webinar, only open to those of you who sign up for it. And again, that is totally free. click the link below in the description section of the video. I'll leave the link there if you'd like to register. So again, my name's Elliot Gu. This is the Deep Dive Investing channel. Thank you very much for listening today. We'll have some more videos out shortly. Thank you.